Welcome to Cheques and Balances. I'm Vincent. This is James Blair. And this week's topic, interest rates.
So this week's topic, Mike, interest rates and what clients and what viewers should be thinking about when their loan matures, when it comes off its fixed period, what are they going to do? We thought we'd run through today maybe historically, why are they so low? What do we think is going to happen and why they're happening?
Yep.
And then Mike as the mortgage broker, as the money man, as interest rates yourself.
I am interest rates.
What people should be thinking about.
Yes, we'll give some general advice around that. Once again, I've got to give the disclaimer, it's not specific, it's just generally what you should be thinking about in the market when interest rates are on the rise.
So first question, Mike, is interest rates are somewhere between how long you fix it, between 2 and 3 point something percent.
Yep.
I know I've still got a loan that hasn't matured yet. I'm very excited. I've got a 3-year loan coming off next month at 4.67%.
Yeah, when you bought that first house for $5 million.
Yeah, that would be nice. The thing there though is going, well, interest rates were quite high a few years ago.
Yep.
And now they're sitting at a much lower point. Let's start with, why are interest rates so low at the moment?
Yeah, so interest rates have been on the way down for a while, but you can sort of attribute the recent sort of levels they've been at. A lot of that's to do with COVID. So as you lower interest rates, it stimulates spending in the economy. As most people have a mortgage, and that mortgage is a large portion of their monthly spending or their free cash flow, the higher the interest rate, the less money they have left over to spend. So because of COVID, the economy was suffering a little bit, well, a lot. So what the Reserve Bank did was they dropped the official cash rate, which drops residential interest rates. It gives people more money to spend. It means that there's more churn of that cash in the economy.
So if we were to keep that really simple.
That was really simple.
If I were to bring it to a James level, an external event happens.
Yep.
The government goes, we want people to feel, we want to control things and make sure we can keep as many people in jobs, as many people in their houses as we can. Mm-hmm. They kind of have some degree of control over interest rates. So they pull the lever that they can pull, which then results in lower interest rates for the person with their mortgage.
Yeah, correct. Not the government though, it is the Reserve Bank, and they are independent, but yes. Yep.
Great, okay. So COVID was a reason, kind of big reason why interest rates dropped. Where do we go from here, Mike? We've had kind of, 18 months since then, interest rates typically trending in one direction. Mm-hmm. There's now a little bit of discussion that things might be changing going forward.
So when you have interest rates this low, and I'm not going to get too far into this because I know you love it when I talk about economics, but
I also know you're very excited about this.
I know. So when you have interest rates this low, monetary policy doesn't work as well, traditional monetary policy, so they print money and do these sorts of things. So generally speaking, the Reserve Bank wants the interest rates a little bit higher than this so that their usual levers that they pull to control finance in the economy works better. So they want them to rise. The other thing that the Reserve Bank looks at is inflation, and you can make the argument that actually the recent rise in interest rates isn't so much to do with inflation, but the supply side shock that COVID has introduced into the economy, which is we can't get goods, we can't get raw materials, that sort of thing, has been forcing the price of things up. You also see that in the services sector, where we can't get staff because immigration has been turned off as well, so that's forcing the price of services up. The Reserve Bank is always going to worry about inflation, and rising interest rates, taking that cash back out of the economy, is one of the ways that they control inflation. So that's why the Reserve Bank governor has been signaling that although the official cash rate didn't change this time, at the next round, it's mostly likely that they'll increase it, which increases retail interest rates. So generally speaking, interest rates are set to be on the rise for the next foreseeable future.
Yeah. And as the world begins to open back up, right, slowly, once again with COVID as well, there's lots of different variables that could put us in a different position.
Yeah.
3 months from now, than we thought we would be. But as the world tends to open up, as maybe employment starts to look a bit better, as the cost of goods start to move, that interest rate number will start to rise.
Yeah, and the other thing is the New Zealand economy didn't do too badly over that period of time.
No, not at all.
the Reserve Bank sort of slashed the interest rates, expecting a really large decrease in productivity and GDP and that sort of thing. It just didn't really eventuate. We lost a fair bit of tourism, but you can only lose that once, because once you close the borders, that's it. And everything else sort of seemed to do fairly okay. So that's the reason now why they're also starting to bring it back up. The economy wasn't in as bad shape as they thought it was going to be.
Okay, so interest rates, we feel like they're heading up at the moment, is the general indication. What are you seeing at the moment in the market? How much are interest rates increasing, and where do you see them continuing to? What's the crystal ball saying, Mike?
I wish I had one. So yeah, look, we're starting to see some of the large retail banks, so ASB, ANZ will probably have increased by the time this goes out as well, pushing up those sort of medium and long-term interest rates and some of the short-term rates as well. So I think ASB is on average about a 30 bips, so 30 basis points increase. So yeah, you'll see that reflected from the other banks fairly soon as well. As soon as one bank shifts, the others usually shift a couple of days later. So you should see the rest of the market follow after ASB's initial move. That's the initial move. The underlying interest rate, the official cash rate hasn't changed yet though. So when that increases, you may see them increase again. But to be honest, I don't think you will. I think you'll just see them, the retail banks, get out ahead of the Reserve Bank and just get a little bit of margin there until the underlying cash rate changes.
I guess it's one of the big questions, right? Is if the Reserve Bank hasn't moved the official cash rate and interest rates are already moving, how do those two things work together?
Yeah, well, it's as the Reserve Bank, and particularly this governor of the Reserve Bank, well, the New Zealand, historically speaking, the Reserve Bank is very good at signalling what they're going to do to the market, because signalling what they're going to do often sort of has the same effect as them actually going out and do it. Because remember, what the Reserve Bank is trying to do here is pull back a little bit on the spending, and among a couple of other things. And just by signalling that they're going to raise the rate, the banks are already getting out ahead of it. So you can see they don't actually have to move the underlying interest rate. Retail banks will go out and try and get some margin ahead of that, essentially get everyone locked in while they can still buy the funds at a cheaper rate.
Great, okay. And for those, with Mike just talking before about bips and basis points, just to kind of explain that, if you're, say, paying a 2% interest rate, that means your interest rate going forward might be 2.3%, so a 0.3% increase. So Mike, if you were to, so interest rates are moving up, there's uncertainty in the world at the moment, just as much as any time before. Potentially some really strong inflation coming in the future, but as well, a lot of questions about the vaccine, supply chains, travel, lots of other different bits and pieces. If I've got my mortgage rolling off, and I know you're going to say it depends on people's situations in terms of how they should be structuring their mortgage. But what are some things people should be thinking about as their mortgage rolls off?
I don't like to sit on the fence, James.
It's uncomfortable there.
It is. I'll give the advice. No, so if your rates are rolling off, or if you're thinking about breaking those rates and refixing them, there's always two sides to the coin, right? The piece we're talking about is what are rates doing in the market. And I think naturally you should always think about that. You want to be paying as less interest as possible. But on the flip side of that is you need to think about, is the product you're getting the right fit for you? There's no good in fixing for 5 years thinking rates are just going to go up if you're going to sell the house in, 6 months, because you're going to potentially incur break costs and fees to get out of that, to sort of get out of that fixed rate lock. And also, in that scenario, you'd be paying too high an interest rate because it's likely that the 6-month rate or the 1-year rate would be a lower rate. So you need to think about what's happening in the foreseeable future. If you have any plans or anything like that could mean you would pay down debt or want to break the loans or sell the house or something like that. Or if you're getting lump sums of money coming in, you want to think about that as well. Maybe you're a contractor and you get paid differently to PAYE. And that can affect how you fix things too. So that's the first side of the coin, thinking about the plans and how that affects things. Now I'll get on to the bit you really want to talk about, if everyone's still awake after I talk about economics, which is what are interest rates doing and what should you do to sort of hedge against that. So generally speaking, at the moment, interest rates are forecasted to rise. We're seeing those big four banks start to shift on that. If you've got interest rates rolling off, you should start to think about those longer term fixes. So It may be that you start to, you could potentially split it as a strategy. So, maybe do some of the loan on a 1 year and some on a 3 year, or maybe some on a 2 year and a 4 year. What that means is you'll have some hedging or protection against that upside movement risk, but you'll get the chance to review your position or half of your position effectively halfway through that term. So if I did, for example, a 2 year and a 4 year fix, I get 2 years in and I can review, see where everything's at, see if the repayments are still all right, see if I need to sell a house or something like that, and then I can make the decision again to lock those rates in again, or put them on floating or do whatever, and then 2 years after that, I'll be able to review my position again. So it's just about staggering a little bit, just to give yourself...
so you don't feel the full impact, right?
Yeah.
That you're not, just like anything, that when you're essentially deciding on how you structure your mortgage, is you taking into account your own situation and a level of risk that you're comfortable with.
Yeah.
So if you've fixed for 1 year, you're going to get the lowest interest rate in the market, but what you roll into in 12 months' time could potentially really hurt.
Yeah.
So when you're making these decisions as well, it's also based off, and what you touched on before, your own situation, but also your risk profile.
Yeah.
If you want the lowest interest rate, you kind of lock it in. If you fix for a really long time, potentially some might call you a bit more conservative, because I guess the other thing to keep in mind before is I've sat in rooms with really smart people in the past where they've predicted interest rates will go up and down, and everyone in the room would agree and everybody was wrong.
Yeah.
So it's interest rates. It doesn't get much harder than predicting interest rates, does it?
Yeah, well, there's a lot that go into them, right? A lot of variables, but that's the thing. It is about looking at your circumstances, looking at your risk profile, and just thinking about how you want to shape your loans to fit that. If you have an investment property, it may be that you want to lock in for 4 years or 5 years, the whole thing. And you might take into account there, actually, I want to know what my ROI, my return on investment, is going to be over this period without interest rates creeping up and eating some of that margin. You'll generally know what the rent is that you're going to get out of it. So this is just another cost that you sort of effectively are going to have to lock in there. So it also depends on what the loan is being used for, as to what, generally speaking, how you fix it as well. So there's a ton of different variables, and this is just general information as to what to do. You should be having really robust discussions with your banker or your broker about these sorts of things, just to make sure, like I said, that product you get is the right fit for you.
Yeah, because you're right. There's so many variables around what your pay will be in the future, how you get paid, are you going to start a family, are you going to move overseas. The point around investment property is very valid. If you were in a position where you could lock in a neutral cash flow, i.e. your rent covers all of your costs for the next 5 years, I could see how that would be incredibly attractive.
Yeah.
Because, I mean, when we do our financial plans, we do forecast interest rates go to 4% after 3 years.
Yeah.
And there's certainly people topping up their investment properties at those levels.
Yeah, and to give you a real life example of that, we have customers at the moment who are shifting out to Great Barrier, and they have an investment portfolio or property portfolio in and around Auckland, some in Whangarei. And Barrier is a little bit of an experiment for them, and they are long-term fixing for that exact reason.
Yep.
They know that they're going to be out there for 2 years, and then they're going to review to see what's going on and do they build out there and that sort of stuff. And effectively what they've done is they've gone, yep, there's the 2 year mark, but we know pretty much that for the next 5 years, we're not going to sell a property. So we just want to make sure we know exactly what the cost is. And if we stay out on Barrier, it's locked in for 5 years. If we come back and kick someone out of our rental houses and move back in, we can do that as well. So it just gives them that level of certainty because of the plans and the changes that they got going on in their life.
Yeah, and I know you and I have been having that discussion very recently about my own property, and I've got quite a lot, because I have quite a lot of debt, quite a lot of debt rolling off, and then talking about splitting it between 1 and 3 based off mine and Hannah's situation, and seeing where Hannah and I will be in 3 years' time as well. So it really does depend on you wanting to be thinking about your situation, how it's going to impact you, thinking about what you're comfortable with. I think that the hedging bets approach has a lot of appeal to it, right?
Yep.
So make sure you're having those conversations, and make sure you're being prepared for when interest rates go up, because as I said, interest rates are a very complex beast, but it does feel a lot like it's happening and will continue to move in that direction. So it's important to plan like anything in life. But we'll wrap it up there. Thank you very much for joining us. Just a reminder, if you've enjoyed this video, please give us a like. Help us by subscribing to the video. If you're on Spotify or Apple, make sure to give us a review. Really does help us spread this message and inform more Kiwis to make better financial decisions. And you'll also notice on our YouTube page, Cheques and Balances, that we've launched a new series, Michael.
Yeah, Money Bites.
Money Bites. So Money Bites is 2-minute episodes talking about money topics. So the first few episodes, I'm going to be talking about what is a share, what is a bond, what is compounding interest.
Yep.
What are your first ones, Mike?
I'll cover off, what is a fixed loan, what is a floating loan, what is LVR, just really basic concepts that, you'll hear out in the market, you'll hear people use that jargon. We just want to explain them to you so you know exactly what you're talking about.
Yeah, so Cheques and Balances is here to stay for a long time. We're going to go more in depth into subjects like interest rates and the other ones we've spoken about, and more we have to come. But Money Bites will be really short, sharp episodes. So thank you very much for watching, and we'll see you next week.
Cheers.